Hello and welcome to another video on our channel, where we talk about how you can improve your financial life and build a more secure future. In today's video, we'll cover an important topic for anyone looking to diversify their investments, real estate investment funds, REITs, and how they can be beneficial for your portfolio. Additionally, we'll explore diversification strategies to reduce risk and increase returns. In this video, you will learn what real estate investment funds, REITs, are and how they work. The advantages of investing in REITs, including dividend payments and exposure to the real estate market. How to use REITs to diversify your investment portfolio and reduce risk. Practical diversification strategies to enhance the performance of your portfolio. Stay with us until the end because, besides valuable tips on REITs, we'll share essential strategies for becoming a more complete and secure investor. Let's begin by understanding what real estate investment funds, REITs, are and how they can be a great alternative for those who want to invest in real estate without having to physically buy a property. What is a REIT? A REIT is a type of investment fund that invests in real estate ventures such as commercial properties, shopping centers, hospitality, and offices. When you invest in a REIT, you buy shares of the fund, and these shares entitle you to a portion of the profits generated by the properties that the fund owns. How do REITs work? REITs work similarly to companies, but instead of issuing stocks, they issue shares for investors. The fund buys properties, and based on the performance of these properties, investors receive a portion of the earnings. The majority of the earnings come from property rentals. That is, when a property generates income through rent, the money collected is distributed among the shareholders of the fund in the form of dividends. Advantages of REITs. Monthly income. Many REITs pay monthly dividends, which can be a great way to generate passive income. Exposure to the real estate market. With REITs, you gain access to the real estate market without having to buy or manage physical properties. Diversification. Through REITs, you can invest in different types of properties and sectors, increasing your portfolio's diversification. Practical example. Imagine you decide to invest in a REIT that owns properties rented to large corporations. Every month, you would receive a portion of the rent paid by these companies, without having to worry about managing the properties. This provides convenience and consistent returns. Now, let's explore the advantages of investing in REITs and understand why these funds can be an excellent option for those looking for passive income and diversified exposure to the real estate market. 1. Consistent passive income. One of the greatest advantages of REITs is the possibility of receiving monthly dividends. This is very attractive for investors who want a regular stream of passive income. Unlike other types of investments, such as stocks, which may pay dividends quarterly or semi-annually, many REITs pay monthly dividends, offering consistent income. 2. Access to real estate without buying property. Investing directly in real estate requires high initial capital and managing issues such as maintenance and tenants. With REITs, you can get exposure to the real estate market with a much lower initial investment and without the headaches of property management. 3. Diversification and risk reduction. REITs provide a simple and accessible way to diversify your portfolio. Through a REIT, you can invest in different types of properties in various sectors such as offices, shopping centers, and even hospitals. This helps reduce risks, as the performance of your portfolio won't depend on a single property. 4. Liquidity. Unlike physical properties, REITs are tradable on the stock exchange, meaning you can buy and sell your shares whenever you want. This offers much greater liquidity, allowing you to sell your shares at any time. Practical example. Suppose you've invested in a REIT that owns properties rented to large companies. Every month, you receive a portion of the rent. If you need money, you can sell your REIT shares on the market, gaining liquidity quickly, without needing to sell a property. Speaking of diversification, it's important to understand how REITs can be a powerful tool in helping you reduce risk and increase returns in your portfolio. Why is diversification important? Diversification means spreading your investments across different assets, so that if one underperforms, others can offset the loss. Diversifying your portfolio is one of the best ways to reduce risk and ensure that your portfolio remains stable and resilient. How do REITs help in diversification? REITs are an excellent way to diversify your portfolio because they provide exposure to different types of properties and sectors. Let's see how you can diversify with REITs. 1. Sector diversification. You can invest in REITs that own properties in different sectors, such as office spaces, shopping centers, logistics warehouses, and even hospitals. Each of these sectors responds differently to the economy, and by diversifying across them, you reduce the risk of relying on one sector's performance. 2. Geographic diversification. REITs can also provide geographic diversification. Some funds invest in properties across multiple cities or even states, helping to reduce location-specific risks. 3. Multiple property funds. There are REITs that combine different types of properties in a single portfolio, further enhancing diversification. With these funds, you can invest in a single asset and gain exposure to various property types, helping to protect your portfolio from downturns in specific sectors. Practical example. Imagine you own shares in a REIT that has office buildings leased to large companies and another REIT that invests in logistics warehouses. If one sector faces a downturn, such as an economic slowdown affecting retail, the other sector may continue generating returns, helping to protect your portfolio. Now that you know how REITs can help diversify your portfolio, let's explore some strategies for maximizing returns with these investments. 1. Invest in well-managed REITs. The management of the REIT is one of the most important factors for investment success. Well-managed funds with experienced teams and deep market knowledge tend to perform better. Before investing, research the fund managers and the fund's strategy. 2. Monitor earnings and dividends. Track the earnings of your REITs and the dividends paid each month. A good REIT should provide consistent and predictable returns. If a fund starts showing a significant drop in dividends, it could be a red flag to review your investment. 3. Use liquidity to rebalance your portfolio. As we mentioned earlier, REITs are traded on the stock exchange, meaning you can easily buy and sell shares. Use this liquidity to rebalance your portfolio. If one REIT is underperforming or you find a better opportunity, you can sell your shares and invest in a more promising REIT. Practical example. You can monitor the performance of your REITs, and if you notice one fund isn't doing well, sell your shares and invest in a fund with higher potential for growth and dividends. Now that you know all about real estate investment funds, REITs, and how they can be an excellent option to diversify your investment portfolio, remember that diversification is key to reducing risks and maximizing your returns. If you liked this video and want to learn more about finance, investments, and how to build a successful portfolio, subscribe to our channel and turn on notifications so you don't miss any content. Our goal here is to help you understand more about the world of investments and make informed decisions to ensure a more secure financial future. Thank you for watching, and see you in the next video.